welcome back to another one of my videos. And today we are going to talking about market volatility, what it really means, how it affects the price movement, and why it matters for traders like us. So, market volatility basically refers to how aggressively or unpredictable or the unpredictability of the price moves on a given asset over a certain period of time. When prices move erratically, often breaking through support and resistance levels with no clear structure or direction, that is a sign of high volatility because the price is not respecting the levels, and therefore we do say that the markets are more volatile. Uh, this, for example, it could mean that the prices are not respecting this area of resistance or support, and therefore we would just say that it is a volatile market. If I give you an example, like if the market is just moving up and down without an actual sign that is actually respecting areas of support or resistance, that means that we are on a volatile market. This is an extreme, of course. On the other hand, when the price is moving more predictably, excuse me, respecting key supports of resistance levels, whether they're static or dynamic, we're likely dealing with a volatile market or more stable market, therefore called non-volatile markets. These two ends of the spectrum are the most extreme. So basically, these are basically just examples, just to have a more clear idea what's volatile and non-volatile markets, and therefore we know anything in between is how the majority of the markets actually move. Because we cannot just say that the market is non-volatile or just volatile, because they don't always respect the levels, and therefore we could just call non-volatile. But anything in between is how the markets actually move, because we can see that here, the price, for example, has actually broke out of the resistance level and then came back. And then if we put another area of support here, to which actually really respected, so we could say that it's non-volatile, or you know it's a more stable price, and because it reacted here, it reacted there, and then moved to the upside. And then, for example, here it reacted on the support, it reacted on the resistance, came back down, and then reacted again from the support, broke out from the resistance, and therefore, we could say it's a volatile market, and then came back, not respecting the level. And then actually, what happened here is that the price actually creates another level of support, and then this would be called another level of resistance, because resistance is the ceiling, and then another area of support. So, putting it simply, a volatile market is one that moves unexpectedly, often with large candles, breakouts, and less structure. And the less volatile market is one that is moving more within the expected levels, offering a clear zones and potentially trade setups. Recognizing the volatility in the markets can help us decide what kind of strategy to apply, whether you should wait and adjust your risk or just go with it. Um, and therefore, that's how we can recognize how the market is behaving, if it's volatile, not volatile. It's always within spectrum, and then adapt our strategy in order to fit in with that market, or how the price reacts within a certain asset. This is going to be a very short video, because this is it's just there's just simple concepts. It's just more to have an awareness of what is volatile and non-volatile. So I hope that you found this helpful as well. Make sure you like the video, subscribe, and stay tuned for more of price action breakdowns like this. Thank you very much for watching. See you next time.